So hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm with Marco Santanché. He runs Unbiased Alpha, and Unbiased Alpha builds strategies for investment managers, hedge funds, and so on. He is a quant, and he has a pretty good experience. He worked at Credit Suisse and other big banks. So Marco, please introduce yourself, and then we'll get into the content of today, where you explain all the strategies and how to build a strategy.
Hi, Giacomo. Thank you. And hi, everybody. I'm Marco Santanché. I'm the owner and founder of Unbiased Alpha. We are a consulting company that focuses on systematic strategies and algorithmic trading. We have experience in a number of asset classes and industries. I am in particular experienced in the past. I've been in Neuberger Berman, Credit Suisse, and worked in major hedge funds or investment management companies, which focused on macro investments mostly. Currently, I'm actually more on other fields, for example, in cryptocurrencies investments, in stocks, even some macro, of course, effects and so on. And yes, I've been working for almost 7 years in the industry, more than 7 years in the industry. So I consult prop trading firms, fintech companies, startups, hedge funds, and so on in building their own strategies and infrastructure for trading and investments. Thank you. Okay. Today we're going to speak about systematic strategies, which are our focus as a company. We also provide data science services and AI in general, but we are focused on investment strategies. And in particular, systematic strategies are those strategies which are managed automatically by an algorithm or trading infrastructure, trading bot, and or platform. Our development starts in Python. Then, of course, we can extend to multiple programming languages, but our main focus is in Python. And we build systematic strategies for our clients. Strategies, why strategies, and what are strategies? Well, investment strategies are a little bit different from trading strategies because they target a longer term capital appreciation, and normally they are managed at lower frequencies. So daily would be probably the maximum frequency, even less than daily, so weekly, monthly, and so on. And the target is, of course, to adjust the strategic asset allocation only on some pre-specified dates or when a particular condition occur, such that we keep our long-term target but adjust to short-term misalignments in the market. And trading strategies are instead a little bit shorter term because they normally target either daily or intraday frequencies. And the target is the same, capital appreciation, but the portfolio or positions are normally adjusted more often. Why strategies and who needs strategies? Everyone would need strategies to invest, of course. Even the simplest strategy, buy and hold, would have it needs a reason to be in your portfolio. Active investors are actually looking at higher returns, excess returns over their benchmark. That is basically why they look for alpha and outperformance relative to this benchmark. On the other hand, we have passive investors, which anyway need a strategy to replicate the benchmark they are trying to follow. And normally, it's not an alpha-seeking strategy, so it's a strategy that actually tries to minimize the tracking error, but still there are several ways to achieve the same target. At Unbiased Alpha, we develop strategies with a very simple, let's say, structure, although it can become very complex, and it is based on a building block approach. We start from the data, which is coming from broker APIs or provider APIs of any other kind. Can be public, can be private, can be news API, and so on. And the data flows into the signal, which is the alpha seeking signal. That's why normally it's not really necessary for passive strategies, but it tries to find value or statistical evidence that some particular data would basically produce additional value for your portfolio if we enter into a long, a short position with some intensity on some specific assets and so on. Then we have asset allocation, which focuses on the relative weights in terms of dollars, or dollar amount, or anyway cash amount in your portfolio according to the assets you have to invest, given the signal, or if there is no signal in general in your universe. And then we have execution. The execution management system is actually a crucial component, especially at higher frequencies. The target is to achieve the desired asset allocation with a number of orders and different type of orders and different strategies that can be developed in order to move your portfolio towards the desired allocation. Finally, we have risk management systems, which are actually an integral part of the entire flow. They can be at the alpha signal levels, such that we basically filter out risky signals, for instance, or they could be in the asset allocation step, where we, for example, avoid concentration risk, or they could be in execution, such as, for example, avoiding orders which could not be filled, depending on liquidity, or, for instance, with stop losses, take profits after we executed our strategy. The signal itself is actually the core of the strategy. Not necessarily it's the most important part, especially when we discuss about passive investments, but still it is where the most of the data is actually used. And in particular, we can see how much we need to invest, or how much is, let's say, advised from the model to invest in particular assets, or if we need to enter or exit these assets. They can come from statistical models, machine learning, or just investment analysis, fundamental analysis, anything else. And they are an essential part in active investments, because they allow us to achieve this outperformance if they are done correctly. But they don't necessarily need to be sophisticated. Sometimes very simple signals can be more important and useful whenever we use, for example, a more sophisticated asset allocation. Regarding asset allocation, indeed, the model behind asset allocation allows us to determine the proportion of the dollar or cash amount we need to invest in a specific asset, or maybe rebalance existing allocation. And they can come from statistical models, again, machine learning, and portfolio optimization, numerical optimization, and anything else. The simplest model is probably dummy investments, or how we call it, which would be basically equal investments, for instance, or maybe, for example, fixed investments, such as always long, and just adjusting the weights according to the model. Normally, it's a model that actually makes it that actually makes a lot of calculations that can be intensive. But that's not necessarily the case. They can also determine the allocation to basket of assets. So, for instance, in pairs trading, where we have a couple of assets that we need to invest in at the same time, we could identify the weight to the entire basket and across baskets. And it is an essential part, normally, I have to say, overlooked by retail investors or non-professional investors, especially when the signal is very technical or very dynamic, like entering and exiting during the day. But actually, it's very important, because whenever we have multiple assets, we need to manage the potential relative underperformance or overperformance, and the weight we give to each of them. And it must be very practical. It must be focused on leverage, fees, rebalancing logic, for instance, based on time or based on particular misalignments with the target allocation and so on. So it needs a little bit more practical considerations than than the alpha signal. Moving on to the execution. In execution, we achieve the allocation we identified in the asset allocation model. And this can be done in the simplest way, so with market orders, but that's not necessarily the only way. Or we can split the order into multiple smaller orders according to the market conditions and liquidity, or additional, maybe even machine learning statistical models. It must manage liquidity risk. It must manage the fact that sometimes our orders are not executed or are not immediately executed. And depending on the filling type, for instance, good to cancel or good till date, and so on. And this can be also very crucial, especially on short-term frequencies. And for instance, intraday or HFT. And it is also strictly related to risk management, because normally risk management, not necessarily, but we can have stop losses which allow us to control risk, and they are executed as additional orders in the strategy. And finally, in risk management, we can actually relate risk management to all the other components or blocks in our strategy. And it can target, as mentioned already, the signal, the asset allocation, or the execution, or do something else. Normally, the idea is to rebalance our portfolio, stop loss, take profits, filtering the signal, and similar actions depending on the conditions. They can trigger orders, and normally alpha signal and asset allocation don't really trigger orders, but they need to flow into the execution management system. Well, in this case, we could, for instance, have a separate execution system that allows us to place stop losses or take profits according to the conditions we want. And yeah, that's it. Very brief summary, but the idea is we can then play around with all these blocks and build our own systematic strategies. We would have full control over all the aspects of the strategies, using these and potentially other blocks. Using the data and potentially adapting to all market conditions, systematic strategies are actually have an advantage over discretionary strategies. They can help in acting faster, avoid some risks such as fat finger or any human intervention that could actually be at risk because of many factors. And the building block approach allows us to actually switch strategies very flexibly and build our own strategy using single blocks that perform more, let's say, atomic actions. In this way, we can customize or modify maybe the strategy according to the new frequency or asset class we are trying to move into. And that allows us to also be very scalable in terms of coding and development time. Thank you.
Okay. I got a question. So, in case somebody wants to start out with building strategies, is it something that people can do even with a very low budget, like, for example, downloading the data from Yahoo Finance, or you need somewhere you need to have a higher budget in order to have better data, and so that you can develop a strategy on your own better?
Yeah, it's an interesting question, and actually you don't need particularly high budgets. You would need to spend a lot of time, that's for sure, because you need to build, maybe start simple, of course. So starting from something that is maybe easy to develop also in Python or in any other programming language. And then moving on, you can further refine, for instance, the signal or the asset allocation model you want to use and so on. But it's relatively straightforward in the sense that the flow is clear, and you don't have to think that it's like super sophisticated also in terms of programming. You don't need particular skills, particularly high level skills in programming, which of course help and of course will eventually pay out. But I think the most important thing is to spend a lot of time. And Yahoo Finance data is perfect, or any other public data or semi-public data such as broker APIs. If you have a free account on some brokers, for instance, Binance, you can already download some data, and that could help you in developing some strategies. It won't be easy because a single strategy can take months to be found, but one must start somewhere, right? And so I think definitely Yahoo data has no problem, or free data in general is not necessarily worse than premium data, which of course will hide some alpha, maybe more complex or more sophisticated alpha, but still it would be even probably very difficult to achieve to identify this alpha source from premium data, which are maybe more complex or very broad, and one needs to make a lot of pre-processing steps to filter them. If we start from prices, we can already identify very interesting strategies that can allow you to basically play around and maybe trade directly and see if you can actually build a trading system for yourself. It starts simple, then you refine it on all the aspects, but I think it's very it's at your disposal as far as you spend a lot of time investigating and studying, and probably also learning to program properly.
Okay. So thank you for taking the time. I think this is the first of a series, so make sure to stay tuned for the next videos I'll make with Marco. And yeah, thank you for your time, and see you for the next video.
Thank you. Thanks everyone, and just feel free to contact me at our website or with my email, and I will be happy to reply to any questions or doubts you might have. Thank you, and see you soon.
Will be in the description, so it will be pretty easy to find out. So thank you, Marco, for taking the time, and this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.